Trillions of dollars move through currency markets every single day, and much of it is borrowing that appears on nobody's books. Last lesson, our Tokyo pension fund grabs dollars by swapping yen. No loan on any ledger, yet it's borrowing. That invisible debt is why dollar shortages erupt out of nowhere. Now watch $100 million travel. The fund repos its bond, sells it for cash today, buys it back tomorrow. With a 2% haircut, a $100 million bond yields $98 million in cash. Here's the trick. Each lender reuses that same bond as collateral for its own borrowing, rehypothecation. The same $100 million backs loan after loan after loan. After 3 reuses at a 2% haircut, that original $100 million can appear to back roughly $294 million in credit, close to 3 times the original, seeming to exist in several places at once. Same bond, multiplied liquidity. This is the engine. Trillions in repo daily, trillions more moving through FX markets, and a vast pool of Eurodollar credit abroad, all built on the same scarce, safe collateral. So here's the switch. When the central bank does QE, buying bonds, expanding its balance sheet, it injects base money, adding reserves to the system. But it also pulls safe bonds out of the market, swapping prime collateral for reserves that don't always serve the same role. It moves the tide and reshapes what the machine runs on. Flip it. QT shrinks the balance sheet, letting bonds run off and draining reserves back out. As collateral returns to the market and reserves fall, there can be less fuel for repo, swaps, and rehypothecation. The tide can go out everywhere at once. And when collateral loses value, loans get called, assets get dumped, prices fall further, a self-reinforcing liquidity cascade. That's how a quiet drain becomes a crisis. So remember, the central bank's balance sheet is the master valve. It sets the safe collateral that gets multiplied across the globe. Grow it, the tide floods. Shrink it, every market drains. Thanks for watching. If this made it click, subscribe for more.